be exploring some key aspects of the international debt market. It might sound complex, but it affects countries' economies and even everyday life in many ways. We've broken down the topic into 5 main areas, and each of us will guide you through one part. Let's start with Mr. Amazon. We'll talk about what happens when things go wrong, sovereign debt crisis.
Things means you're wrong. So what is sovereign debt crisis? Simply put, it's when a national government cannot pay back money it owes in sovereign debt. What causes it? Several things can lead to this. Sometimes a government spends much more money than it earns over long period. Big economic shock like a global recession or a natural disaster can suddenly reduce country income. For financial management or even corruption can also play a role. Sometimes factors outside the country like sudden increase in global interest rates can make existing debt too expensive to handle. What are the consequences? They are often served that country's economy can surge, leading to job losses and hardship for citizens. This is called a recession. Investors lose confidence and might stop lending money, making it even harder for the country to recover. Sometimes this social unrest, the government might be forced to make painful cuts to public service like healthcare or education. How do countries respond? There are a few options. They might implement austerity measures, cutting government spending or raising taxes. They can try the restructure their debt, which means negotiating with lenders for the better terms, like more time to pay or lower interest rates. Sometimes international organizations like the International Monetary Fund, IMF or World Bank provide bailout loans, but these usually come with strict conditions for economic reform. Sometimes, unfortunately, there are no easy fix, and the country faces a long, difficult recovery. Basically, a debt crisis is a serious situation with tough choices. Now, Mrs. Rindle will explain the role of companies that evaluate a country risk of getting into such trouble.
Thank you, Mr. Amazon. That leads perfectly into the role of credit rating agencies in the international debt market. You've probably heard names like Moody's, Standard, Poor's, and Fitch. These are the major trusts. What do they do? This main job is to assess the credit worthiness, essentially the ability and likelihood of borrower like government or a large company to repay its debt. They do this by analyzing economic data, political stability, financial health, and other factors. How do they present this? They issue credit ratings, which are like the grades 3A, 2A, 1A, 3B, 2B, 1B, 3C, and so on. A high rating like 3A suggests very low risk. The borrower is very likely to repay. A low rating like 3C or below signals high risk. This significant chance they might default or fail to pay. Why does it matter? This rating heavily influences investors. If a country has a high rating, investors see it as safe and are willing to lend money at lower interest rates. If a country has a low rating, investors demand higher interest rates to compensate for the high risk, making borrowing more expensive for the country. So, credit rating agencies act as important information providers in the market, guiding investment decisions and impacting borrowing costs of entire nations. However, they have also faced criticism, sometimes for reacting too slowly to changing risks or for potential conflicts of interest. Next, Baya will talk about specific way countries borrow internationally Eurobonds.
Thanks, Ms. Shaira. Let's talk about the Eurobond issue and its implication for emerging economies. What is Eurobond? Despite the name, it doesn't necessarily have to involve Europe or the euro currency. A Eurobond is simply a bond issued by a country or company outside its home market, and often it's a currency difference from its own. For example, if the Philippines government issue bond denominated in US dollar and sold them primarily in London and Singapore, that would be a type of Eurobond. Why do emerging economy issue then? Emerging economy countries that are developed economically often use Eurobond for several reasons. Access to capital. It's allowed them to tap into as much a larger pool of international investors and borrow larger amount that might be available domestically. Diversification is diversifying their funding sources so they aren't solely reliant on local bank or market. Potential for lower costs. Sometimes borrowing internationally can be cheaper than borrowing at home, especially if international interest rates are low or their domestic market isn't very developed. What are the implications? The effect. Benefit. Access to needed funds for developed project, infrastructure, etc. Risk. The main risk is currency risk. If the emerging economy borrow in say US dollar and its own local currency, again the dollars, the debt becoming much more expensive to repay. In local currency term, this can be strained government finance significantly. They also become more exposed to global financial shock. So Eurobond often opportunities but also current risks, especially related to currency fluctuation. Speaking of global factor, Ms. Villarosa will now discuss how global interest rates affect developing countries.
Exactly, Ms. Baya. My topic is the impact of global interest rates on developing countries, or debt servicing. So debt servicing just means making the required payment, interest, and principal on borrowed money. So the connections. Many developing countries, as Baya mentioned, borrowed money internationally, often in major currencies like the US dollar. The interest rates on these loans are frequently linked to benchmark global interest rates, particularly those set by major central banks like the US Federal Reserve. What happened when global rates rise? When central banks in major economies like the US raise their interest rates to control their own inflation, this has a ripple effect worldwide. For developing countries with existing variable rate loans where the interest rate changes over time, their interest payments automatically go up. New borrowing also becomes much more expensive as lenders worldwide adjust their rates upwards. So the impact of the global interest rates on developing countries' debt servicing. This increase in debt servicing costs can be used for them. Money that could have been spent on essential services like schools, hospitals, or roads now has to be delivered to pay higher interest on debts. This can slow down economic development and in severe cases push countries closer to the kind of debt crisis Baya described earlier. It makes managing national budgets much harder. So decisions made in Washington or Frankfurt about interest rates can have very real consequences for the finances of developing nations. So lastly, we'll talk about a newer, more positive trend in debt markets, so green bonds.
Thanks, Ms. Villarosa. While we discuss risks and challenges, there are also positive developments. One of these is green bonds and sustainable financing in international debt markets. What are green bonds? These are basically loans or bonds where the money raised specifically are marked for projects that have positive environmental benefits. Think of funding renewable energy projects like solar or wind farms, energy efficiency improvements, clean transportation like electric buses, sustainable water management, or reforestation efforts. Why are they important? Green bonds connect the huge global debt market with the urgent need for environmental protection and climate action. These allow investors who care about sustainability to put their money into projects that align with their values. They provide issues, governments or companies with a way to finance green projects and potentially enhance their reputation as environmental responsible. They help channel much needed private capital towards achieving climate goals and sustainable development. Growth. The market for green bonds has grown rapidly in recent years, showing increasing interest from both borrowers and lenders in financing a sustainable future. While challenges remain in standardizing what counts as green, it is a significant step towards making finance work for the planet. So to wrap up, the international debt market is a complex ecosystem. We've seen how sovereign debt crises can arise from various factors, can have harsh consequences. Mr. Amazon report. We learn about credit rating agencies and their crucial, though sometimes debated, role in assessing risk. Mr. Rendon report. We look at Eurobonds as a tool of emerging economies to raise funds, bearing the both opportunities and currency risk. Mr. Baya report. We understood the global interest rate changes directly impact the debt burdens of developing nations. Ms. Villarosa report. And finally, we touch upon green bonds as an innovative way to finance sustainable projects. Understanding these elements help us see how interconnected global finance is and highlights the importance of responsible borrowing, lending, financial management for countries worldwide. Thank you to all the speakers. We hope this overview has made these important topics a bit clearer. That's all. Thank you.